Hey, can you guys hear me?
Yeah, I can hear you.
Thank you.
Sweet. All right, we'll just give it another second while we wait for other people to show up. Where's everyone? Where's everyone zooming in from today?
Maryland for me.
Maryland, nice.
I'm in Georgia.
Georgia, okay. I'm out of Seattle. Houston. Oh yeah, the weather up here is amazing. It's 73 degrees right now. I got all my windows open. Um, haven't even needed to turn on the AC unit yet this summer. Actually, I don't even have an AC unit. I just have a fan.
Now I'm just jealous. It's been burning up down here
Where are you based out of?
in Georgia.
Oh, I bet it's really humid down there.
Yes, it is.
Oof. Yeah, not a fan of the humid heat. All right, we'll just give it another minute.
So this is my first time joining this kind of boot camp. So what
Yeah,
what is what usually happens? Like you just go through.
yeah, that's a good question. So, I guess we can go ahead and start and I'll kind of walk through it. So, we offer live classes. That's basically what the boot camps are. And we have a variety of different topics that we cover. So I'll show you the topics that we cover. So we cover statement of cash flows, earnings per share, leases, income taxes, the equity method / acquisition or consolidation accounting, cash to accrual, bonds, not-for-profit, inventory, and intercompany. And sometimes we'll also insert in like government accounting. It kind of just depends on the month, but we've got other boot camps that we rotate in. But the classes are an hour long. We generally focus the classes around like task-based simulations and multiple choice questions. So we spend most of the time working through problems together. And as we work through the problems, we go over some of the more important concepts to like understand. So this is definitely not like a college lecture where I just get up and like dump information at you. Instead, we focus specifically on problems that you're likely to see and then go over, what you need to know and some of the tips that you can apply to kind of help you work through problems. So that's the idea. Like I said, the classes are an hour long. We record all of the boot camps. So if you ever like miss one or you have to leave early, you'll get access to that. Yeah, and I generally try to get people's participation. Like I don't cold call anyone, but I like to ask if people have questions, just so that it's an engaging experience and people can actually learn, right? That's kind of how the boot camps work. Did that answer your question?
It does. And for the classes, I know this one is free, but for the ones that are not free, how much do you charge?
Yeah, so I'll go over some of the pricing at the end. But you don't pay for each class. When you buy a boot camp, you get access to all of these classes, basically. So the prices when we go over them, those are not going to be the prices for like one specific session. It'll be the price to attend all of these classes. So I'll go over that at the end because I know a lot of you just kind of want to get to the material.
Right.
But I will say that I have a discount code. So all of you are going to get 25% off access to the boot camp, which is pretty awesome. And I'll provide that to everyone at the end of this session. Also, I'm recording this and I'll send it out to everyone. So if you want to go back and kind of review some of the things we talked about, that will be available for you as well. Okay, so let's jump in. Like I mentioned at the beginning, the way these boot camps work is we pick a topic and we try and focus on task-based simulations to help people prepare for what they can expect to see or potentially see with questions related to this topic on the exam. So for the statement of cash flows, we're going to focus specifically on the operating section. Right. Obviously, the statement of cash flows has the investing and the financing section, but we're not going to spend time with that today. We're going to focus more on the operating section because that is where you're likely to see a sim, specifically in preparing the operating section using the indirect and the direct method. But I just want to provide a quick resource to people. Let me share this in the chat. This is a YouTube link. If you've ever been wondering how to like easily remember or know which items fall under which section on the statement of cash flows, I think you'll find this song to be really helpful. It's called the Cash Flow Song. It's really catchy and it'll help you learn which financial statement line items go under the operating section, the investing section, and the financing section. So it's kind of a fun way to like learn, you know, what goes where. So take a look at that. I think that'll be helpful for, you know, figuring out where stuff's supposed to go. But let's go ahead and jump into the operating section. Now, the operating section can be prepared using two different methods. We have the direct method and the indirect method. And regardless of which way you prepare the operating section, you'll get the same answer, right? So it doesn't matter which method you use, but you need to know how to use both of them because you're likely to, you know, you're likely to be asked about potentially both of them. Let's see. Yes, let me share that link really quickly. Let's see, meeting info, copy link. I don't think there's a password. Let me just check really quickly. Let me check and see if there's a password on the link. Okay, CPA, sweet. Yeah, there you go. Okay, so let's start with the direct method. Now, the direct method is what is required by US GAAP. And this method starts at the top of the income statement, and then we work our way down the income statement, converting each accrual-based income statement item to its cash basis equivalent, right? So we start at the top and we work our way down and we convert each accrual-based item to its cash equivalent. So revenue will convert into cash collected from customers. Cost of goods sold, we will convert to cash paid for inventory. And then our operating expenses, we will convert those to cash paid for operating expenses. And the net of that will be our net cash inflow or outflow from operating related activities, right? So that's how we set it up. Now, when I prepare under the direct method, I like to use a tool. And this little matrix can be really handy for preparing under the direct method. You don't have to use this if you don't want to, but I think it's really helpful for kind of keeping everything nice and organized. And the way it works is we dump the income statement in this first column, right? We just copy and paste it into that first column. We then make adjustments in this second column to convert each accrual-based item into its statement of cash flows equivalent. Right, the whole purpose of the statement of cash flows is to reconcile beginning cash to ending cash, right? And so with the statement of cash flows, we're looking at cash both inflows and outflows. And so we're trying to convert our accrual items into the equivalent cash inflow or outflow, right? So let's go ahead and practice. We're going to be taking a look at a sim today. So in this simulation, they gave us two exhibits. They gave us an income statement and they gave us a balance sheet. Now, whenever you're provided with exhibits, you always want to make sure you familiarize yourself with them before you attempt to solve the problem, right? Even if the sim has like 10 exhibits, don't just like jump into the problem. You want to read through each of the exhibits to familiarize yourself with what's on them. So as you start working through the problem, you can identify which exhibits you're supposed to be looking at, right? Now, that's easier said than done because sometimes, you get a sim and you're like, I have no idea where the heck I'm supposed to start. Well, start by looking at the exhibits, right? I would say that's the best first step that you can take, right? So we see that we've got our income statement. It's for year 3. And then we have a balance sheet that gives us end of year 2 and end of year 3 balances, right? So end of year 2 is the same as beginning of year 3. Now note which column refers to which year, right? This first column is our beginning balance. The second column is our ending balance. You really want to make sure that you get that correct, because if you aren't careful with which column you're pulling from, you're going to mess the whole problem up, right? So pay very close attention to dates. Okay. Now, let's go ahead and start by copying our income statement and dumping it into this first column, right? That's the first thing we're going to do with this matrix here. So we take our income statement and we put it into this first column here. Okay. The next step is we're going to start working through our income statement, right? So basically the process or the approach that we take for the direct method is we look at each income statement line item, and we then look over to the balance sheet to see if there's related accounts. Then we adjust our income statement account for the balance sheet accounts, right? So looking at revenue, if we come back to our balance sheet, we see we've got accounts receivable, inventory, prepaid, accounts payable, wages payable, unearned revenue, and income tax payable, right? Well, accounts receivable is definitely related to revenue. So is unearned revenue, right? So we're going to be making adjustments for those two balance sheet items within our revenue account number, right? Okay. So let's start with unearned revenue, right? Unearned revenue is a liability, meaning it has a credit balance. If we take our beginning balance and our ending balance and plug it into our T account, we can solve for the missing piece, right? We see that deferred revenue decreased by $800. So what's the journal entry that we would make to record this entry in the T account, right? We're debiting deferred revenue. Well, we're going to be debiting unearned revenue for 800, and then we're going to be crediting revenue for 800, right? That's the journal entry that we're making here. Basically, we are earning revenue that was previously deferred. Now, the idea with unearned or deferred revenue is we were paid cash up front for goods or services we hadn't yet provided, right? For example, let's say that we own a lawn mowing business and our neighbor pays us $1,000 to mow their lawn for the entire month, but they pay us up front. That money is not revenue because we haven't actually done any work. We haven't mowed any lawn yet, right? So it's actually a liability because by receiving or taking that cash, we are now obligated to provide lawn mowing services for the next month. So a decrease in the deferred revenue account would indicate that we have now performed service or provided goods that we were previously paid for upfront, right? So we're trying to convert this revenue of $20,000 to cash that we received from customers, right? Well, within that $20,000 revenue amount, we have $800 of earned deferred revenue, right? That $800 is not connected to any cash. In other words, within this $20,000, 800 of this $20,000 amount is related to cash that we were previously paid upfront, but for goods or services that we hadn't provided, right? So what we want to do is we want to subtract this $800 out. And we want to do that because this $800 of revenue that we have now earned is not connected to any cash. There's no cash that's connected in the current period to that 800. So we're going to subtract it out because we're trying to convert that 20,000 into cash that was collected. So if there's no cash that was collected or associated with this $800 of earned deferred revenue, then we're just going to back it out, right? So by subtracting 800, we are removing the pure accrual revenue we recognized from earning this deferred revenue. Any questions about that? Does that make sense to everybody, how we kind of approached that? And you can type in the chat, you can come off mute, I don't care either way. I just want to make sure that everyone is understanding what's going on here.
It made sense to me.
Okay, perfect. All right, so let's go on to the next one. So accounts receivable, right? So our accrual revenue number is 20,000. We just determined that $800 of that is related to deferred revenue that we've now earned. What this means is the remaining 19,200 must be related to sales made on account, right? Basically, we're bifurcating that 20,000 because the $800 that was included in that is not related to sales made on account. It was related to cash that we were paid up front, which, you know, we've now earned. So 19,200 is the remaining amount of revenue, and that's coming from sales made on account, right? So accounts receivable, this is an asset, meaning it has a debit balance, right? So we plug in our beginning balance of 1,000, our ending balance of 800, and then we plug in the 19,200, which is what we just solved for, right? After removing the deferred or the earned deferred revenue, that's the amount of credit sales that we've made in the current period. We can then solve for the missing piece of the T account, which is 19,400. So the 19,400 reflects the amount of cash that we ended up collecting from customers, right? That's the answer we were trying to get to. We were trying to convert our accrual-based revenue number of 20K to the cash that we collected from customers, right? That's the cash basis equivalent. And so what we're going to do then, right? We subtracted 800. We're going to now add 200 to convert the 19,200 to the 19,400. So the net effect of that is a negative 600, right? We subtracted out the 800 to remove the pure accrual revenue. And then we added 200 to convert the sales made on account number to the cash collected from customers number, right? And that's what we want to show. On our statement of cash flows, we want to show the cash that we collected from our customers, right? So we have a negative 800, a positive 200, that nets out to be a negative 600, which when added against our income statement revenue number of 20,000 gets us to 19,400. Any questions on that?
No questions.
Okay, perfect. Let's look now at cost of goods sold and accounts payable. So cost of goods sold, this is the next income statement line item, right? Like I mentioned with the direct method, we start at the top of the income statement and we work our way down. And as we work through it, we look to the balance sheet for related accounts. So cost of goods sold is connected to inventory and accounts payable, right? It's connected to inventory because when we sell inventory, we generate COGS. And it's connected to accounts payable because when we buy inventory on account, it goes through accounts payable, right? So it's kind of indirectly connected to COGS. So what we're trying to convert here is cost of goods sold to the cash that we paid for inventory, right? That's why we need the AP account, because the AP account will tell us how much cash we paid for purchases that we made on account, right? So let's set up our inventory account first. This is an asset, so it has a debit balance. We plug in our beginning balance of 900 and our ending balance of 1,100. And then we take our cost of goods sold number of 6,300 and plug it into the credit side. right? When we sell inventory, the journal entry that we make is a debit to cost of goods sold and a credit to inventory, right? So by using COGS and our understanding of journal entries, we can essentially fill out this piece of the T account, and then we can solve for the 6,500. So 6,500 represents the purchase of inventory that we've made on account, right? And the journal entry that we would make is a debit to inventory for 6,500 and a credit to accounts payable for 6,500, right? So using this entry, we can then fill out part of our accounts payable T account. Accounts payable is a liability, meaning it has a credit balance. So if we take our beginning balance of 1,100 and our ending balance of 1,500 and plug in the 6,500, which represents the purchases that we've made on account, then we can solve for the missing piece of the T account, which represents the cash payments that we've made for purchases on account. And that comes out to be 6,100. So on our income statement, we are expensing 6,300 as an accrual expense, but we actually paid out 6,100, right? So we want to make a positive adjustment of $200 to convert the negative 6,300 to negative 6,100. And in this particular problem, the parentheses indicate a negative number, right? Not a credit. Sometimes when you see parentheses around a number, it's used to indicate that something has a credit balance. In this problem, it's used to indicate that something has a negative balance, right? So we're trying to convert from COGS to cash paid for inventory, right? So we're going from 63 to 6,100. And that's what we're going to show on our statement of cash flows. We will show cash paid for inventory of 6,100.
I have a quick question.
Yeah, what's up?
How did you say that? Can you go back up, please?
Uh-huh.
So, like, how does the cost of goods sold relates to the inventory again? Because you put it on the right side.
Yeah, that's a good question. So think of the journal entry we make when we sell inventory, right? The journal entry is going to be to debit COGS, which will increase the expense, but we credit inventory, right?
When we sell it?
When we sell it, yep.
Okay,
And so by looking at COGS, we can figure out the amount of inventory that we sold. And on our inventory T account, inventory that we sell falls under the credit side.
Gotcha.
Does that make
Okay,
sense?
makes sense, yeah.
Okay, perfect. Any other questions?
And the same applies for the account payable.
Yeah, so with the account payable for that one, we solve for the inventory account, we solve for the missing piece of 6,500, right? And that represents purchases of inventory we've made on account, right? We've got our beginning balance of 900. We have our ending balance of 1,100. And then we solve, this comes out to be 6,300, right? So if we start the year with 900 and we end with 1,100 and we sold 6,300, we must have bought 6,500, right? The journal entry for that would be a debit to inventory of 6,500 and a credit to accounts payable, right? So then we can use that journal entry to help us fill out our T account. We have our beginning balance, our ending balance. We then plug this in, whoops, 6,500. And then we can solve for whatever is right here.
Which is the cash we actually paid out.
Yep, because the only thing that will reduce payables, well, I guess there's two things, but the most common one is when you pay off a payable, right? The
Right.
journal entry you make is a debit to AP and a credit to cash, right? The only other thing that would decrease your accounts payable is if you like returned items, right? But you're probably not going to see that in a statement of cash flows problem. So just assume that any decreases in the AP account are as a result of paying down the purchases made on account with cash.
Yeah.
Okay. Any other questions about this one?
I'm honestly still a little confused onto why you're using the 6,500. You know, to like, if for example, you have the AP journal entry, you have the beginning account, you have the ending account.
Mhm.
How do you know that you need to use that 6,500?
Well, with our inventory account, we determine that 6,500 is the amount of inventory that we bought, right?
Right,
This is the journal entry that you make when you buy inventory, right? Our inventory account is increasing by 6,500, which is coming from this debit here.
gotcha.
And the only way our inventory increases in this case is if we buy on account. And if we buy on account, it means our payables are increasing, right? And the increase in payables needs to equal the increase in inventory because we are buying the inventory on account, right?
Okay, makes
And
sense. It's
so-
actually the combination of these two transactions together that
Yep.
gives us the amount of cash that was actually paid out.
Yep, and the reason for that is generally inventory is bought on account. So you
Right.
can't look to the inventory account alone to figure out cash paid for inventory because the cash outflow is coming from the AP account. So
Makes
what you're gonna
sense.
do is you're gonna fill out the inventory account first, and then you can fill out the AP account, and within the AP account, you can figure out how much cash was paid out. So
Makes
that's why you kind of have to do both of those T accounts.
Gotcha, gotcha. All right, that's clear now. Thank you so much.
Yeah, you bet. Okay, so these first two I think were the most challenging, right? Accounts receivable, unearned revenue, and then cost of goods sold or inventory / AP, right? I think those are the most tricky because we have multiple balance sheet items that we need to adjust for in one income statement line item, right? We're adjusting COGS for inventory and AP. We're adjusting revenue for both unearned revenue and accounts receivable. So those are the more tricky ones because we have to set up multiple T accounts. For everything else, it's really just smooth sailing from here because everything else has just one balance sheet line item, if that. Some of the income statement items we're going to look at don't even show up on the balance sheet. So everything else from this point forward is going to be a lot easier. So looking at salaries expense, we show 1,500 on our income statement. The balance sheet equivalent of this is wages payable, right? Now, wages payable is a liability, meaning it has a credit balance. So if we take our beginning and ending balance and plug them in, and we use the salaries expense, right? The journal entry for this would be a debit to salary expense, 1,500, credit to wages payable for 1,500, right? We can solve for this piece right here of the wages payable account, right? Basically, what we're doing is we are accruing for our salary expense, and by accruing for it, we're going to increase our wages payable account. So once we've figured out that piece, we then have 3 of the 4 pieces, and we can solve for the debit side of the account. Debit side for liabilities represents like paying down the liability, right? Because that's what will decrease it. So this 1,750 represents cash payments that we've made for accrued wages, right? So if we paid out 1,750 for wages, but we only expensed 1,500 on our income statement, we're going to want to make a negative adjustment, right? Because we're trying to show the cash that was paid out for wages. So if we paid out 1,750, right, but we only expensed 1,500, by subtracting 250, we convert the negative 1,500 to the negative 1,750, right? So that 1,750 then will show up as cash paid for wages on our statement of cash flows. Okay, now other expenses. So this one, I think sometimes people get a little bit like hung up on. Let's just take a look at our balance sheet here, right? We've worked through accounts receivable. We've worked through inventory. We've worked through AP and wages payable and unearned revenue, right? So all of those balance sheet accounts have already been accounted for. And we've got this other expense, right? So looking at our balance sheet, is there any account or accounts that are potentially related to our other operating expense? Well, income taxes payable is a no, because we see income tax expense is listed down here, right? So the only other thing we have is this prepaid expenses. Can prepaid expenses be related to other operating expenses? And the answer is absolutely, right? When we use up a prepaid asset, the journal entry that we make is we debit an expense account and we credit our prepaid asset. Right? So we know that when we use up our prepaids, for example, let's say you prepay for rent, as time passes, you're going to be expensing that prepaid rent to kind of show the consumption, right? Or the using up of that asset. So that other expense likely is going to be this prepaid, is going to be related to the usage or the consumption of that prepaid expense, right? No other balance sheet account on here makes sense, and we've already worked through everything else, right? So that's kind of how we know that we're supposed to be looking at the prepaid account. Now, sometimes on the exam, they will bury multiple operating expenses within that category of other. They'll stick depreciation and they'll stick interest within the other expense category. So just be aware of that. They'll give you some type of like exhibit, or they'll tell you that they'll give you a breakout of what expenses are being included within that other expense line item. So just be aware of that sometimes they can bury stuff in here. They're not doing it in this problem, right? We see that depreciation is clearly being broken out. So is interest. There's no indication that this other expense line item has anything other than usage or consumption of our prepaid assets, right? But just be aware of that. Other problems might have it. And in fact, in the actual boot camp that we, the actual statement of cash flows boot camp that we run, we actually look at another simulation where depreciation is kind of baked into this other financial statement line item, and we have to back into what it is, right? So that's something that you would get in the normal boot camp. But looking at the prepaid expenses, this is an asset, meaning it has a debit balance. So if we plug our beginning and ending balance in, and then we plug our expense in, right, we can solve for the missing piece, which is 1,050, right? And the reason that we know that that 1,000 is supposed to go there is because we have a $1,000 expense. And when that expense is created, it corresponds with a decrease in the prepaid asset for the same amount, right? So essentially we are debiting other expense for 1,000 and we are crediting the prepaid asset for 1,000. Okay, so this missing piece that's highlighted in yellow, that 1,050, that reflects prepaid assets that we paid for, right? It represents increases in the prepaid account. Well, an increase in the prepaid account would be due to purchasing prepaids, right? The journal entry for this would be a debit to prepaid and a credit to cash. So this is the number we're trying to convert to, right? Because that reflects the cash that we paid for this operating expense. So our income statement shows an expense of 1,000. We paid out cash of 1,050. So we want to subtract 50 to convert from the 1,000 to the 1,050. Any questions so far?
No question.
Nope, you're doing good.
Okay, sweet. Okay, let's hit depreciation now. Depreciation is a non-cash expense. This one's really easy. Now, like I said, sometimes they'll bury it in the other financial statement line item, but regardless of where they stick it, cash is always a depreciation is always a non-cash expense. When you depreciate your assets, you don't pay cash for them, right? So with depreciation, we just want to reverse out the entire thing. Remember, what we're trying to do here is we're trying to convert our accrual numbers to their corresponding cash inflow or outflow. Because there is no cash inflow or outflow with depreciation, we just remove it entirely. So by adding $1,000 back, we ensure that nothing shows up on our statement of cash flows, which is what we want because you don't pay out cash for depreciation, right? So we add back $1,000 and that will cause nothing to show up on the statement of cash flows, or it'll cause like 0 to show up on the statement of cash flows for depreciation, right? Okay, now our gain. So why are we reversing out our gain? And this rule applies for losses as well, right? For gains, we subtract them out. For losses, we add them back. The idea is this, right? Let's say that we have a sale of a fixed asset, right? Gains are generated and losses are generated from the sale of investments or fixed assets. Let's say we sell a machine, right? Let's say that we sell the machine for $20,000. Let's say the accumulated depreciation on the machine was $10,000. And let's say that the cost of the machine, the original cost, was $20,000, right? So we have a machine with a net book value of $10,000. We're getting $20,000 of cash for it. So our gain would be $10,000. The cash from this transaction right here goes in the investing section of the statement of cash flows, right? The investing section, the whole point of that section of the statement of cash flows is to show inflows and outflows from the purchase and sale of fixed assets and investments, right? So basically, if we don't reverse out the gain, we're going to be double counting cash in both the investing section and the operating section, because all of the cash associated with this transaction is already in the investing section. Additionally, the gain itself is an accrual concept, right? So a gain is a non-cash item, even though it's related to a transaction where cash is taking place, right? So we want to back out the gain or add back the loss because one, the cash from the transaction is hitting the investing section, and two, the gain or loss itself is an accrual concept, right? So because it's a pure accrual number, we got to back it out. So we're going to subtract out the full 2,000. By doing that, we essentially ensure that it does not show up on our statement of cash flows, which is what we want. Any questions about depreciation or the gains / losses?
No question.
I have a question.
Yeah, what's up?
I'm backing up a little bit. Where you have the salary right
Mhm.
here for the total gain. Oh, you moved it right here. So no, back right there.
This one?
Yeah, look. You're moving back up. Back up right here. So you have stop. Why is it moving?
It shouldn't be.
Could you go back down?
Let's see, to this slide,
To the other one. Right here,
the other
So-
expenses.
right here, where you have salary, total salary expenses.
I think there might be a lag on your end because I'm on a different slide right now.
I think slide 14 is where she's mentioned.
Right here.
Yeah, this one.
Yes.
Okay.
No. Right here, total salary adjustment. Okay, so for salary, you have, in the income statement, a negative 1,500. And you're making an adjustment for 250.
Mhm.
So the SCF is negative.
1750. Are you asking why the adjustment or why the total is 1750?
Yes, because I'm thinking All right, go ahead.
So the reason it comes out to be 1750 is because that is the cash that we paid for wages payable. In other words, that's the outflow of cash that we made to pay off the wages that we accrued for, right? Remember, we're trying to convert each of our operating expenses to the corresponding cash outflow. So on our income statement, it's showing 1,500, but we actually paid 1,750 for wages related expenses, right? So we want to subtract 250 to convert the 1,500 to the cash equivalent or the cash outflow for our wages.
I got that. So scroll back down because the 250 here is a positive 250. It doesn't have the asterisk around it. So that was what was throwing me.
Oh, yeah, I
As
think
a
it's
negative.
yeah.
No,
I would pay attention more to the color because it's in red. We treat it as negative. I think
Negative,
the
okay.
parentheses
That's
just
what
got
was
left off.
throwing me. Okay, because I didn't see the negative, so I was just like, huh? Okay, all right, perfect.
Yeah, so
Thank
anything
you.
that's green, just treat that as like an addition.
Positive,
Yeah, and then anything that's red, just treat that as a subtraction.
awesome, thank you.
Yeah. Okay, so moving on, let's hit interest. Now, interest doesn't even show up on our balance sheet. Why is that? Well, when we look at our balance sheet, if we see something that's connected to an operating expense, it's because we are accruing for it. When we accrue for an expense, really what that means is we are just delaying the payment of that expense until a future time, right? If we accrue for wages, we record the expense because the labor costs were incurred in, whatever time period we're talking about, but we accrue a liability to show that a cash outflow for those wage or labor costs is not going to come until a future time. So if there's nothing on our balance sheet, it means there is no timing difference between when the expense is incurred and when we're paying it off. So basically the journal entry that we would be making here is we would debit interest expense for $500 and we're crediting cash for $500. And we know this because there is no payable on our balance sheet related to interest. And so it must be that we paid this expense in cash when it was incurred, right? If we didn't pay cash for this expense, we would have recorded something like an interest payable. But there's no payable, which means we're not delaying payment of this expense, we're paying it as it's incurred, right? So because our cash outflow matches the accrual expense that's on our income statement, we don't need to make any adjustment here. Now we want to make sure that the 500 still carries over, right? This is different than depreciation and gain. Depreciation and gain are non-cash items, so we don't want them to show up. Interest expense requires no adjustment, but we still want it to show up because there is cash that's related to this expense, right? So no adjustment is going to be made in this middle column. Instead, we just bring the full 500 over, and that represents cash that we paid for our interest. And once again, we got to that point by looking at our balance sheet and noticing that there's no payable here. So the only way this journal entry could have been recorded is if they debited interest expense and credited cash. Okay, now the final one is income tax expense. Income tax expense shows up as 4,200, right? So the journal entry to record that would have been a debit to income tax expense and a credit to income taxes payable. If we take our beginning balance of 3,000 and our ending balance of 1,000 and then plug in the accrual for the current period income tax expense, we can solve for the missing piece of the T account, which is 6,200. And that represents cash outflows for income tax payables that we've made, right? So on our income statement, we're showing an expense of 4,200, but we actually paid 6,200 for this income tax payable, right? So we want to make a $2,000 negative adjustment to convert our accrual based number of 4,200 to the corresponding cash outflow of 6,200. So that's the adjustment that we'll make. The final thing we do then is we look at our third column, this statement of cash flows column, and we net these together. So we take the cash from customers, we subtract cash we paid for inventory, cash we paid for wages, cash we paid for other operating expenses, cash paid for interest, cash paid for taxes, and that leaves us with a net inflow of 3,800. So the total cash that we brought in from our operations is $3,800. Okay, any questions about how we handled the direct method before we move on to the indirect method? Now, one thing I'll say as well is the reason this matrix is so helpful is because it keeps everything nice and neat. When you get a direct method question, they are not just going to ask you for cash from operations. That will be one answer that they require. They are likely going to ask you, what is cash from customers? What is cash paid for other expenses? What is cash paid for wages? What is cash paid for interest? Right? You're not just going to be asked about cash from operations. I mean, maybe if it's like a multiple choice question, but in a sim, no way. They're going to ask you multiple things. And so this matrix helps you easily identify each of the statement of cash flow items, as well as, the total inflow or outflow from operations. So it's really easy to set up and it keeps everything nice and organized. And you could do this on a piece of scratch paper, like no problem. You just kind of set up the matrix, you do your T accounts to figure out what the adjustments are. And then whatever the numbers in that final column, right, the statement of cash flows column, that's what you'll use for your answers. Okay, now indirect method. So the indirect method is a little different from the direct method because instead of starting at the top of the income statement and working our way down, we start with net income. Because we start with net income, we're going to be making adjustments for all of our balance sheet items, right? Essentially, we are either including or backing out things from net income to convert to cash either received or paid out for operating activities. So the final answer is the same for the direct and indirect method, but the presentation of it's different. We don't start at the top of the income statement and work our way down, converting each income statement line item to a cash inflow or outflow, right? That's how we do it with the direct method. With the indirect method, we literally just make adjustments to net income to spit out cash from operations or cash paid out for operations. So it's generally considered to be quicker because we're not having to convert each line item. Instead, we're just making little adjustments to net income to convert that to cash. Now, with the indirect method, you apply a set of rules to help you convert net income to cash collected or paid out from operations. And what's really cool is if you learn the rules, you can actually apply those to the direct method to help you prepare it quicker. So I'm going to teach you the indirect rules. We're going to prepare an indirect method problem, and then I'm going to show you how those adjustments are the exact same as what we'll make with the direct method. So here are the rules, and I would, if there was one slide I would encourage you to remember, it's these, because if you can, this slide right here, these rules, if you can remember these rules, it will help you on the statement of cash flow stuff like nothing else will. So assets have an indirect relationship. Current assets have an indirect relationship. What this means is if we're looking at an account and it's a current asset, if the current asset is going up, the adjustment that we make to net income is going to be a subtraction. If the current asset goes down, we're going to add to net income. If we're looking at current liabilities, these have a direct relationship. In other words, if a current liability goes up, we will make a positive adjustment or we will add to net income. And if we have a current liability that goes down, we treat that as a negative adjustment, or we subtract from net income. Now, why do we do this? Well, the whole point of these adjustments is to capture whether cash is coming in or out. So let's think of current assets. Think of inventory. When you sell inventory, meaning the asset goes down, cash goes up, right? Now, maybe you sell an account or something, but just assume, right, that we're selling inventory not on account. When your inventory goes down, your cash goes up, right? Or think of like an accounts receivable. When you collect an accounts receivable, the asset goes down and you're collecting cash, right? Now, what about like a prepaid asset? How does that work, right? Because if I use my prepaid asset, that doesn't mean I'm bringing more cash in. Well, if you use current assets that you already have, instead of going out and buying more, it just means you have more cash available, right? So a decrease in current assets corresponds either with more cash being made available or an inflow of cash. Now, what if your current assets go up? Well, if inventory goes up, it's likely because cash is going out the door, right? You're spending cash to buy inventory. Or what about a prepaid asset? Well, if your prepaid assets are going up, it's because you're paying cash to buy more prepaid assets, right? What about a receivable? Well, if a receivable goes up, that doesn't necessarily mean cash is going out the door. But if you sell to people on account as opposed to in cash, you are choosing to allow cash to be tied up in the receivable, right? So when you sell on account, cash gets tied up in the receivable. Eventually you'll get the cash, right? But that cash is going to be temporarily tied up in that receivable. So you have less cash available now than you otherwise would if you didn't sell on account. Now, liabilities, I think, are a bit easier to understand. If you pay for something on account, or if you accrue an expense, we treat that as a positive adjustment because it means more cash is being made available, right? If you buy inventory on account, you're basically saving yourself from having to pay cash for it today, which means more cash is available in your pocket today as a result of that, right? Or if you accrue for like wages, it means you get to keep more cash today, right? Because you're not paying cash for those wages today, right? Now, if liabilities go down, it's because you're paying them off. If your accounts payable balance goes down, it's because you are paying off purchases made on account. So cash is going out the door, right? Or with wages payable. If your wages payable is going down, it's because you're paying off wages that you accrued for. So those are the rules. Current assets have an indirect relationship with the adjustment that we make. Current liabilities have a direct adjustment, a direct relationship with the adjustment that we make. And the adjustment is just the difference between the beginning and ending balance. So we just look to see how the account changed, and then based off of whether it's a current asset or current liability and the direction that the account is changing, we make our adjustment. So let's look at an example, and this is the exact same problem we've been looking at. It's just in this giant Excel sheet here. Right? So we just did this. We literally just prepared the direct method. Let's now do the same problem using the indirect method. Okay? And let me change which screen I'm sharing on. I want to use my bigger monitor just so everyone can see it. Okay. All right, so looking at the indirect method, we start with net income, right? So net income is $7,500, so that's where we start. That's how we kick off the indirect method, right? We always start with net income. Now, depreciation and the gain, I think those are the easiest ones to understand once again. We're trying to convert net income into cash. So depreciation is a non-cash expense. We deducted $1,000 of depreciation as part of calculating net income. right? It literally shows up on our income statement. We deducted it as part of calculating net income. So what we're going to do is we're going to add it back, right? We're going to add it back because this is not related to cash. It's a non-cash expense. So by adding it back, we essentially undo the effect of deducting or including that $1,000 accrual expense in net income. Same for the gain. We included a $2,000 gain as part of calculating net income. Well, the gain is not connected to any cash here. So we want to subtract it out as part of converting net income into cash. And we do that because there's no cash associated with that $2,000 balance, right? So we just want to back it out completely. Now, inventory is our first real opportunity to apply the rules we just learned, right? We come up to inventory. Inventory is a current asset. Current assets have an inverse relationship with the adjustment that we make, right? So we see that the inventory account is increasing by $200. An increase in current assets, right, equals a decrease or a negative adjustment. So the adjustment we want to make here is going to be 200, and it's going to be negative because our inventory account increased. So we're going to subtract $200. Now let's take a look really quickly at accounts payable. Accounts payable is a liability. It's a current liability. Current liabilities have a direct relationship, right? So the account went up by $400. This means that we add $400, right? An increase in current liabilities equals a positive adjustment. And the reasoning behind that is if our accounts payable balance is going up, it means we have more cash available because we are accruing for our purchases, right? We're basically just buying on account. So we have a positive $400 adjustment from accounts payable. We've got a negative $200 adjustment for inventory. That's the exact same adjustment that we make under the direct method, right? A positive 200. Now, why does it show up differently? Well, remember, with the direct method, we look at each income statement line item, and then we go over to the balance sheet and we make adjustments for the balance sheet related accounts, right? So revenue, or sorry, cost of goods sold is connected to inventory and accounts payable. So we make adjustments to COGS for inventory and AP, but we do it in one line item because we work through one line item at a time under the direct method. With the indirect method, we take net income and we make adjustments for each one of our balance sheet accounts, right? So the net effect of the adjustments is the exact same. It's just presented differently, right? Because with the indirect method, we start with net income and then adjust for each balance sheet account. With the direct method, we're making all adjustments for a related account within that line item. So for revenue, we're adjusting for every balance sheet account within that one line, right? Every balance sheet account that's related to revenue, we're adjusting for in that one line item. For cost of goods sold, everything on the balance sheet related to cost of goods sold is being adjusted for in that one line item, right? So we're basically just kind of consolidating the adjustments under the direct method. But the net effect is the same, right? Now let's look at accounts receivable. Accounts receivable is a current asset, meaning it has an inverse relationship. The account is going down by $200, which means we add $200. So that's where this adjustment's coming from. Let's take a look at unearned revenue. Unearned revenue is a current liability, right? So it has a direct relationship. The account is going down by $800, meaning we subtract by $800, right? So we have a subtraction of 800 for deferred revenue. We've got an addition of accounts receivable of 200. Look, that matches the adjustment that we make under the direct method. It's just presented differently because once again, with the direct method, we are adjusting for all balance sheet related accounts within each income statement line item. But the net effect is the same. Now for prepaids, prepaid, that's a current asset. It's increasing, which means we subtract. So we subtract $50. Wages payable, that's a liability, meaning it has a direct relationship. The account is going down by $250, which means we subtract $250. And look, that matches the adjustment here. And the adjustment that we made for prepaid matches the adjustment here. Income tax payable, that's a current liability. The account went down by $2,000, meaning we subtract $2,000 because it has a direct relationship. That matches the adjustment here. And you see the net cash from operations is the same. So what you can do to prepare the direct method is you just follow the indirect rules. Starting with inventory, we'll come over to our balance sheet, right? And we'll say revenue is related to accounts receivable and unearned revenue. My accounts receivable went down, which means I add 200, or sorry, yep, no, that means I add 200. And then my unearned revenue went down by 800, meaning I subtract 800. So I add 200, I subtract 800. The net of that is negative 600. For cost of goods sold, I look at my inventory account and my accounts payable. My inventory went up, meaning I subtract 200. My accounts payable went up by 400, meaning I add 400. So I have a positive 400 and a negative 200. Boom, that gives me my adjustment of 200. For salaries, right, we come over, we look at wages. My account went down by 250, meaning I subtract 250. For other, I come to my prepaid expenses. The account went up by 50, meaning I subtract 50. Boom, there's my adjustment. Depreciation and the gain are easy. We just completely reverse those out. Interest doesn't require an adjustment because we didn't accrue for anything, right? We basically just paid the expense, so the cash outflow matches the accrual expense. And then for our income tax expense adjustment, right, our payable decreased by 2,000, meaning we subtract 2,000. So basically what I've just shown you is you can use the indirect rules to prepare the direct method very, very quickly. And those rules, you need to know them anyways in order to prepare the indirect method of the statement of cash flows. So you might as well use them to prepare the direct method too. Any questions about that? How we handled that? Does that make sense to everybody? Perfect. Yeah, I would say if you can nail down these rules, it will help you prepare anything related to statement of cash flows like much, much faster, which is what you want, right? You know, you don't want to spend 30 minutes on a statement of cash flows sim when you could do it in like 15 minutes. So learn those rules. And I will say, when you convert from cash back to accrual, it's helpful to know these rules because if you flip them on their head, you basically just flip the rules and then you can convert back from cash to accrual, right? So we have a whole nother boot camp on that, where you're asked to convert items from accrual to, or from cash to their accrual equivalent. And these rules are a good foundation for learning the adjustments that we make to kind of go the other direction. Okay, so that's it for our session. That's an example of how our boot camps operate. Now, I'll just provide some general information about what the schedule looks like and then like pricing information, because I know we had people that asked about that. But that's an example of what the boot camps look like. We like to work sims together. I love to take questions. That's really the whole point of the boot camps, is to work difficult problems together, and to show you tips and tricks to kind of work through some of these more difficult concepts. So yeah, now in terms of pricing, let's see. Thank you. Yeah, that's great to hear. Let me pull up the website for you guys. So in terms of pricing, if you buy an individual session, it's going to be $3.99, right? And you have 3 months of use for that, right? So if you were interested in buying just the FAR Bootcamp, which gives you access to all of the classes, right? Let me come over here and show you this. All of these classes are included in that $3.99, right? So you get to attend 10 classes basically for $400, but I have a 25% off code, so really you're only paying like $300, so pretty good deal. So yeah, 3 months worth of use. So for 3 months you can attend the FAR boot camps, or whatever boot camp you want to attend. Now these other packages, these give you access to all of the boot camps for either 12 months or 24 months. Now, the advantage of this is, let's say you bust out FAR and you want to attend boot camps for like BEC to get that exam done before it changes and becomes, 3 different exams. The advantage of buying 12 or 24-month access is you can just immediately start attending those other boot camps, right? So basically you have a year to attend as many boot camps as you want across all the different exams. So you could attend an audit boot camp, you could attend a few RIG boot camps. So that's really what you're getting with, the 12 and the 24-month access ones. And it's cheaper to buy these 2 packages instead of pay for each exam individually, right? If you pay for each boot camp or boot camps for each exam individually, you're going to end up spending a lot of money. It's a lot cheaper to just buy these packages if you plan on or are interested in attending boot camps for other exams after this. Additionally, you only get 3 months, right? So if you think it's going to take you longer than 3 months to bust out an exam, might be worth your time to consider looking at some of these other ones. Now, the discount code I want to share with you is you can either use Bootcamp 25. Let me drop that in the chat below. Or you can use Dexter 25. That'll give you a 25% off discount on any of these packages. So, you'll save a good chunk of money with these boot camps. Additionally, I'll drop my phone number and my email. And if you end up buying access to one of these boot camps, you can just email me or text me and I will help you get access to everything that you need. So when you pay for access to the boot camp, it doesn't automatically like give you access. We kind of have to add you in. We have a Facebook page where you can interact with other people who have purchased access to the boot camps. We post like tips and tricks. We post links to the recordings on Facebook. We also have a Google Drive where we store everything that you'll have access to. So if you want to look at, the slides, or you want to look at prior recordings, all of that's in the drive. So if you end up purchasing one of these, just let me know. You can email me, you can text me, I'll help you get access. I'm like super responsive. Yeah, is there a separate package for just practice questions and sims? Yeah, absolutely. So if you're interested in just getting access to like the sims and stuff, let's see. Right here on this page, let's see, there's the pricing. So $2.99 will get you access to all of the sims, the lectures, the multiple choice questions, the readings and stuff for one section, right? You could do a monthly subscription as well if you want, or you could, buy access to the full course. The full course will give you all of the sims, multiple choice. It'll give you everything for all of the exams, right? The monthly subscription will as well, but if it's going to take you like 15 months to pass all of the exams, that's kind of expensive, right? So you can either use the single section or the full course. Or you could do the monthly subscription, but those discount codes I gave you will work for this as well. So you'll get 25% off a single section or full course or even a monthly subscription. But like I said, if you if you decide to buy one of these and you need help like actually getting access to the platform, you can either just like text me or you can email me. I'll just drop that again. I'll also say we offer tutoring. So I do like one-on-one tutoring. You can buy individual sessions, you can buy packages. And as part of like tutoring, I always try to help students kind of set up a study plan. So if you're looking for something that's a little bit more structured, you're struggling to figure out what you should be studying, how you should approach your studying, how much you should be doing, when you should take your exam, I can help you kind of figure all of that out. I can even assign you like homework if you want. Like some of the students I'm working with right now, they like me to check in with them every day, kind of check up to make sure that they're doing their assignments that I've kind of divvied out. So that's available as well. And in terms of like the tutoring, we meet for an hour. We can work questions together. I can teach you concepts. I'm not one of those tutors that will just, say, yes, that's correct because it's correct. I, very much like to explain things, to make sure that people are really kind of understanding what's happening. So if you're interested in any tutoring, just let me know. I can get you some more information on that. We also have discounts for that. It's a separate charge, but if you're interested in getting tutoring, we can come up with like a package so you can get access to like some boot camps or a boot camp, plus you can get tutoring, right? So we can make like a package for you to get you a better deal. But as it stands, the tutoring is kind of its own thing, right? But if you're interested in kind of making a package, like let's say you wanted to buy the FAR boot camp and get a few tutoring sessions, we could just create like, a package for you that you could buy. The full course package, I believe it's unlimited. Yes, it's lifetime access. So even with the single section, it's lifetime access. So you're never going to be like kicked out of the Sims and the multiple choice. When you buy it, you get access for everything. If you go monthly though, you only have access as long as you pay, right? So with the review course, you have access forever, but you do not with the boot camps, right? With the boot camps, you either have 3-month access, 12-month access, or 24-month access. Any questions that I can answer about like the boot camps, the review course, tutoring, or anything like that?
So the boot camp is like, is it like live sessions every, I don't know, once a week, or is it like pre-recorded sessions where we listen to them?
They are live. I like to do them live because I like people to ask questions, but I record them. So, if you can't attend or if you, have to leave early, you can go back and watch what you missed. But
And
the
how
sessions.
often?
So for this upcoming FAR boot camp, we will have 4 sessions a week. We have 2 on Saturday. We have one at 12 p.m. Eastern time on Saturday, 1:30 p.m. Eastern time on Saturday, and then we have 2 sessions on Sunday at the same time, right? So Saturday, Saturday, Sunday, Sunday, Saturday, Saturday, Sunday, Sunday, Saturday, Saturday, right? So basically you'll get to drill down on all of these topics. And it'll be like over in 2 weeks. So it's like a pretty intensive course. But the idea is to really kind of get you into shape for some of these more difficult topics that you're likely to see on your exam. And I generally kind of assign homework with them. I don't like grade it or anything like that, but I provide problems for you to look at outside of class to help reinforce what we go over in the boot camps. So by the end of the boot camp, you really, should come away with a much better understanding of some of these difficult topics that you'll see on the FAR exam.
Okay, so the total of 10 sessions a month.
Yep, and sometimes we have a little bit more. We have 2 government topics or 2 government sessions that we usually run. We just don't have them this month. So we'll likely switch those in or include those in future months. We've just been devoting more time to like BEC because like right now the BEC boot camps are just like so many people are attending those because everyone's trying to get the exam done before you know the new changes take effect. But you know you can still watch the recordings for the prior government boot camps even if we don't have it this month. So you're technically getting like 13 boot camp sessions.
Okay.
Any other questions?
So if I get the 24 months access, that I would get like the 13 sessions per month for 24 months. Is that right? Or whatever, the 10 sessions per month for 24 months.
Yeah, you would actually get access to every single boot camp. So you would get access to the BEC boot camp, you would get access to the audit boot camp, the reg boot camp, and the FAR boot camp.
Okay.
So I mean, technically you could attend all of those boot camps each month if you wanted to. You basically get unlimited access to all the boot camps for all the exams for 2 years.
Okay. All right. Thanks.
So yeah, so let's say that you attend the FAR boot camp for July, you pass your exam, you go on to BEC. Within this $9.99, you can immediately start attending the BEC boot camps for as long as you want. And then once you pass that one, you can immediately start doing the audit boot camps. So that's kind of the advantage of the 24-month access and the 12-month access. You're getting access to boot camps for all of the other exams as well. So once you pass whatever exam you're on, you can immediately start attending the boot camps for the other exams. With the single section, when you finish FAR, you could move over. Well, actually, no, it's just for one section. So if you like finish FAR, you're gonna have to buy then the boot camp for audit or the boot camp for reg or the boot camp for BEC, right? But these other ones give you access to all the boot camps for all the exams. Any other questions? Okay, if we don't have any other questions, like I said, you can text me, you can email me, you can even message me on Facebook. And I can help you get access to the platform or the Google Drive or whatever after you've paid for access, or if you'd like additional information about like the tutoring and stuff, just let me know. So this recording should be available probably by tonight. I think we'll send it out tomorrow. So all of you will get a copy of the recording. You'll also get a copy of the slides so you can go back and kind of look through the material if you want. Just let me know if you have any questions. Otherwise, I hope to see some of you guys in the boot camp that's starting on July 1st. Yeah, good luck with your studying. Please reach out if you have any questions. And have a great night, everyone.
Sure. You're gonna send the link to the recording in our emails, just as we got the link for the Zoom.
Yep, I'm gonna send out the link to the recording and a copy of the slides via email. So whatever
Okay.
email you use to
Gotcha.
sign up for this session, that's where the recording link and the slides will be sent.
Okay. Thank you.
Yeah, you bet. All right, take care, everyone.